Costs of capital across countries. We're going to be looking at 3 steps to identify optimal capital structures for multinational companies desiring to pursue projects overseas. Firms pursuing opportunities overseas can potentially save millions of dollars by finding the optimal capital structure, or in other words, the perfect mix of debt and equity to finance their project. The steps to finding your optimal capital mix is quite simple. First, you want to compute the cost of each component of capital. This is simply determining the cost of each financing option available individually. Secondly, select different capital mixes to compare to one another. This is merely drafting potential capital mixes for cost comparison. Each mix will have different weights or even different components altogether. Finally, you will compute the weighted average cost of capital of each potential mix. This metric is used to identify the most cost-effective structure. Let's use ABC Corporation as an example to illustrate these steps. In this example, we will assume this firm to be a United States-based multinational company in the oil refining industry, and they have identified an attractive opportunity in Russia. Now, ABC Corporation is trying to determine the best mix of equity, domestic debt, and foreign debt to fund this venture the cheapest way possible. Furthermore, let's assume that ABC Corporation has been given the following 6 pieces of information. And at the bottom, we can see how each piece of data is then used to complete our first step, which, as you remember, is to compute the cost of each component of capital. Let's look at how we determine our cost of dollar-denominated debt. By adding the risk-free rate and risk premium of dollar-denominated debt provided by U.S. creditors, we then multiply this figure by 1 minus the U.S. corporate tax rate, and this gives us our cost of dollar-denominated debt, which in this case is 6.3%. Following the same logic for Russian ruble-denominated debt, we are able to identify a cost of capital of 10.5%. Finally, the cost of dollar-denominated equity can also be identified. We do this by using the capital asset pricing model. The 6% in this equation represents the U.S. risk-free rate, while the 1.5 is the expected sensitivity of this project and its returns to U.S. investors in response to the U.S. market. This is commonly known as the project's beta. The 14% is the expected U.S. market return, and the difference of this figure and the risk-free rate inside the parentheses is known as a market return. The capital asset pricing model reveals a cost of capital of 18% for dollar-denominated equity. Now that we've completed our first step, we can begin experimenting with different mixes and calculating our weighted average cost of capital. This table represents the fulfillment of our second 2 steps. Note that from the previous slide, one of the pieces of information available to ABC Corporation was creditors prohibiting more than 50% debt financing. Thus, each mix must incorporate at least 50% U.S. equity. The weighted average cost of capital is computed by simply multiplying the cost of each component of capital by its weight and then summing the total. Thus, for the first mix, we take the 30% weight for U.S. debt times the 6.3% cost of U.S. debt to get 1.89%. Then, multiplying a 70% weight for equity by the 18% cost of equity to get 12.6%. Then, adding these together gives us our weighted average cost of capital of 14.49%. After computing the weighted average cost of capital for each mix, we see that the optimal mix in this example is 50% U.S. debt and 50% U.S. equity. The mix that yields the lowest weighted average cost of capital reveals the best mix based solely on this criterion. Other factors like country risk or exchange rate risk can weigh heavily into financing decisions as well. In summary, there are 3 easy steps to identify optimal capital structures. First, compute the cost of each component of capital. Then, select different capital structures to compare to one another. And finally, compute weighted average cost of capital to determine the cheapest capital structure. Now you know how to estimate the cost of debt and equity and optimize your capital mix when financing projects in other countries.